Datavault Inc., trading under the ticker symbol DVLT on the Nasdaq, is currently witnessing active intraday trading at $0.3296 per share, marking a downswing of 2.05% in today's session on this Friday, June 26, 2026. While mainstream market participants frequently look at prominent market indicators like Tesla stock, Apple stock, or Nvidia stock to gauge the broader health of retail tech sentiment, small-cap asset tokenization plays like this one are carving out a completely separate narrative. The immediate surprise that catches most people off guard here is that despite a massive year-to-date collapse from its 52-week high of $4.10 all the way down to these pennies, management just reiterated a full-year revenue guidance of at least $200 million. That implies a massive 400% increase year over year, heavily back-weighted toward the final 2 quarters of this year. This sets up a profound disconnect between the current valuation and the massive commercial milestones the executive team claims are just around the corner. The prevailing public sentiment surrounding this small-cap technology company is that it is a highly speculative, struggling micro-cap stock on the verge of total dilution, plagued by a string of intense class-action investor law firm investigations from entities like Pomerantz Law Firm and Johnson Fistel. If you log into your typical Robinhood app or browse popular investing sites, the general consensus looks grim. Retail traders looking at self-investing strategies often look at a stock trading below 50 cents and automatically assume a Chapter 11 filing is imminent or that the business model has completely evaporated. The reality, however, is significantly more nuanced and far more complex than a simple glance at your individual brokerage account dashboard would suggest. Datavault Inc. actually maintains a remarkably robust current balance sheet, with roughly $250 million in total liquidity and $140 million in working capital, largely secured through aggressive private placements earlier in the spring. This capital buffer completely refutes the immediate assumption of structural bankruptcy, creating a stark paradox where the underlying corporate cash reserves significantly disconnect from the equity's bleeding market valuation. To understand why this gap exists, we have to look closely at the intraday trading volume and recent institutional block activity. Over 16 million shares have changed hands just today, compared to a massive historic average daily volume that has sometimes climbed past 40 million shares during high volatility weeks. This massive turnover points to an ongoing aggressive tug-of-war between institutional funds executing tax loss harvesting or risk mitigation strategies and contrarian retail accounts using platforms like the Interactive Brokers platform or Robinhood Investments to accumulate cheap fractional shares. For retail traders utilizing online investing tools or seeking automated guidance through platforms like Schwab Intelligent Portfolios, mapping out a position in a high beta asset like this requires looking past the daily emotional swings of the order book. When you look at how small-cap equities are handled across major individual portfolios on the Fidelity trading platform or via specialized Fidelity ETFs, institutional accumulation generally requires stable regulatory conditions. Datavault Inc. is currently entirely dependent on the pending passage of the Clarity Act to formalize its tokenomics framework, meaning that until the federal government establishes clear guidelines for real-world asset tokenization, major institutional buyers are forced to keep their hands tied, leaving the asset open to short selling pressure and retail liquidations. Let us add another layer to this current analysis by looking at the earnings metrics that dropped during the last reporting cycle. The company actually reported an earnings per share loss of 9 cents, which unexpectedly beat the consensus Wall Street estimate of a 14-cent loss. Revenue for that single 3-month period landed at $3.42 million. Ordinarily, an earnings beat accompanied by the reaffirmation of a $200 million full-year target would cause an equity to jump. Instead, the stock fell by nearly 15% immediately following the announcement. This counterintuitive market reaction highlights the deep tension between short-term retail expectations and institutional reality. Professional managers using sophisticated institutional setups like interactive brokers stock trading systems are not looking at the backward-facing $3 million revenue figure. They're deeply focused on execution risks associated with the company's massive infrastructure rollouts. The company is attempting a rapid expansion across 100 cities globally, while simultaneously trying to blend recent major corporate acquisitions like NYAX and CyberCatch into its broader digital framework. For any retail trader managing their accounts via SoFi Active Investing or looking for generic investment help on the web, this specific scenario shows why treating microcap tech stocks as simple lottery tickets often leads to massive portfolio drawdowns. Please take a moment to engage with the channel right now. Comment below how many shares of Datavault INC you currently hold in your portfolio, or share your perspective on whether you prefer managing speculative assets via self-investing or through an automated intelligent portfolio. Evaluating the core mechanics of Datavault INC requires stepping back from the immediate price tape to look at what the business actually does. Based out of San Jose, California, with major operational hubs in Pennsylvania, the firm operates as a specialized data sciences and technology provider. The foundational business model centers on enabling enterprise clients to securely value, manage, and monetize their proprietary internal data sets. The company achieves this through a proprietary suite of artificial intelligence agents commercially known as Datavault, DataValue, and DataScore. By combining these tools with enterprise platforms like IBM's Watson X framework, they provide corporate clients with automated financial modeling and risk assessment without exposing sensitive data to public cloud vulnerabilities. Furthermore, through its acoustic science division, the company owns the WISA wireless audio standard and ADO data over sound platforms. Just this week, the firm announced an integration with WISA Technologies to introduce new home theater systems featuring high-end wireless connectivity, alongside an unconventional digital media partnership with the estate of baseball legend Roberto Clemente to manage digital merchandise and historical asset preservation. This dual nature of the company, spanning from enterprise data tokenization to commercial wireless audio solutions, creates an incredibly broad operational footprint that often confuses traditional analysts who prefer clean single-sector businesses. When we analyze the historical financial performance, the company's past reports reflect a classic early-stage cash burn profile. Operating with a trailing 12-month revenue of roughly $41 million and a deeply negative EBITDA of $42 million, the firm has historically relied on continuous equity issuance to keep the lights on. This historical reality is exactly what fuels the ongoing bearish arguments on popular retail trading platforms, from the SoFi trading platform to the Fidelity mobile app. Short sellers point out that a historical net loss of over $120 million makes any future projection of a $200 million revenue run rate look like an impossible corporate fantasy. This is where the tension between historic data and future forward-looking catalysts becomes critically important for anyone engaging in online investing. If the company's recent patent awards for asset tokenization from the United States Patent and Trademark Office successfully translate into commercial multi-million-dollar enterprise contracts in the third and fourth quarters, the current valuation will represent a massive market inefficiency. If those contracts fail to materialize, or if regulatory delays push the revenue recognition into next year, the company will likely be forced to execute another round of capital dilution, driving the share price even lower. Looking forward, there are three distinct operational scenarios that investors using Fidelity Investments, SoFi Investing, or Interactive Brokers accounts must watch. The most optimistic path relies entirely on the successful implementation of their new data infrastructure project across international municipalities. If these local government contracts begin delivering recurring SaaS fees, the stock could rapidly re-rate toward the $3 consensus price target currently held by analysts at firms like Maxim Group. A secondary, more conservative scenario involves the company leveraging its robust cash balance of $140 million in working capital to acquire smaller revenue-generating software firms, effectively buying top-line growth to satisfy suspicious market observers. The most dangerous scenario is an execution failure, where the integration costs of their recent tech acquisitions create an unmanageable cash drain that consumes their liquidity before federal regulations clear a path for their main tokenization products. For an individual managing an individual brokerage account, balancing these speculative microcaps against foundational holdings like broad market index funds or blue-chip tech stocks is a constant exercise in risk mitigation. Many conservative investors prefer outsourcing this asset allocation entirely, relying on systems like SoFi Robo-Advisor or generic Fidelity mutual funds to avoid the extreme volatility of individual stock picking. For those who choose the